Please welcome the panel on Deal or No Deal in Private Equity, moderated by Editor-at-Large for Bloomberg Businessweek, Erik Schatzker.
Thank you. Hey, everybody. Whoops. Oh, that's loud. And good afternoon. I'm not sure whether the Institute, when it named this panel Deal or No Deal, had Monty Hall in mind, or whether they wanted me to channel Monty Hall, but I feel good about it either way. I don't want to go into a lot of background about our panelists. You see their names and the firms they represent here on the screen. If you're so interested to learn more about them, read their bios. You can find that in the Milken app or on the website. The only other thing I wanted to say before we begin is that, as you've probably heard from other moderators, your participation is not just welcome but encouraged. I'd love to see some questions from the audience up here on the iPad that they have so conveniently provided me with. And let's see if it's all working. It's working. So if you have questions, they'll show up here. And I'd love to see them. And my job is to try to work them into the conversation as things go along, as opposed to waiting, say, and giving you 15 minutes of audience Q&A at the end. I think this way works much better in my experience. So, as they say, without further ado, let's begin this conversation. Deal or no deal in private equity? Actually, I do have one other thing to say about our panelists, and that is that it's a diverse group, and that's terrific for a conversation about private equity. We have three managers, David, Scott, and Jacob. Alicia is our allocator, and Wilson here is our liquidity provider in the secondaries market, mostly in the secondaries market. And so you're going to hear a different perspective from each of those three groups, and even within or among the private equity managers, a different perspective. I want to begin, somewhat obviously, with First Republic, because all the conversation at my dinner table last night was about First Republic and where the market and the economy would be this morning if the FDIC didn't find a buyer last night. And thankfully, I suppose it did. None other than President Biden himself says the banking system is safe and sound, and if the president says it, it must be true. One of the guests, however, at my table, and this is where private equity enters the conversation about First Republic, runs a private equity firm himself. And he said that he thinks it's outrageous that private equity was and has been excluded, utterly shut out of the government-run efforts to save first Silicon Valley Bank, next Signature Bank, and of course, as of last night, First Republic. I can't think of a better way to start off a panel called Deal or No Deal in Private Equity than by asking my panelists about a situation in which there was obviously no deal in private equity. I should add, on the private equity subject, that my colleagues at Bloomberg have reported Apollo and BlackRock were ready to backstop PNC's bid, but that's obviously not the same as being invited to make an offer. So, to my panelists, do you share the outrage? Do you share the frustration? Do you think the company could have, would have been better off today if private equity had been allowed to buy SVB or Signature, or come up with a solution for First Republic that didn't require the FDIC taking a $13 billion hit? And I'm going to pick on Wilson first.
Thanks, Erik. I'm not outraged at all. I think that whether it's Silicon Valley or First Republic or Signature I'm less familiar with, I think it's really a question of confidence in the business model and the size of the hole in the balance sheet here. And I think, actually going back to Silicon Valley Bank, I think there was a prominent private equity firm that had agreed to participate in a rights offering that did not slow the flow of deposits out of the institution. I think eyes were on First Republic for a long period of time. We had the deposit influx of $30 billion from large banks. That didn't stop the stock from falling. And I think the resolution, including the FDIC and JP Morgan, was quite elegant and timely and sent a signal of organization to the markets. And so I'm thankful for that. And final note, just First Republic is a business partner of ours and many private equity firms, and they have quite a phenomenal franchise within private equity, different than Silicon Valley Bank, but I think that was sought after and valued by JP Morgan.
David, Scott, or Jacob, you're the managers here. I'm guessing, based on what I know about your businesses, that none of you was about to enter a bid for either of those three institutions. But what we're talking about here is a principle, right? The principle, or at least the idea that $2 trillion of capital should be excluded from a saving or resolution process or whatever it is. And clearly, part of the issue here is that legislators and regulators in the United States and elsewhere view private equity with skepticism, in some cases enormous skepticism. And the huge lobbying efforts by the American Investment Council haven't yet changed that perception. A, do you have any thoughts on whether it is right or wrong that this enormous pool of capital shouldn't play a role in perhaps driving a better deal for the banking industry and ultimately the taxpayer? And what it might take for the industry to get beyond that? Jacob?
Yeah, I would just say I agree completely with Wilson that the most important thing in the context of a bank being in trouble is to, as quickly as possible, instill confidence. And I'm not sure today the private equity industry is a good industry to do that for consumers who can flee with their deposits on a daily basis. If you remember back when Washington Mutual failed, just prior to its failing, another prominent private equity firm invested $750 million in to stabilize, and it did absolutely nothing. So it might be the quickest way to lose money as a private equity investor today to participate in trying to stabilize a bank that people are concerned about.
At One Rock, we invest in industrial companies, so I have absolutely no skin in this game. But from a fundamental perspective, I'll take the other side of that, Jacob. I mean, in my mind, if a private equity firm, knowing the rules of the road, how regulated the bank is going to be, wants to help shore up the balance sheet with an infusion of capital, you know, I don't think it should necessarily be precluded from doing that. Just fundamentally, the mass of dry powder out there that is available to help businesses shore up their capital situations it's just massive. And to exclude from a failing institution, if a private equity firm is willing to take on that risk, I would say, you know, it's probably not a bad idea to let them do that.
It's really hard to paint private equity with one broad brush. And to your point, excluding all the capital seems a little bit short-sighted. Having said that, and I'm not a financial services investor either, so I have definitely no skin in the game either, but banks are incredibly heavily regulated, incredibly levered business models. So leverage on leverage can usually be a pretty risky game, which is why probably a lot of us don't do it, and why firms that do tend to focus on it. And I think First Republic was a successful PE deal previously as well, before they went public. So people can make a lot of money. Like a lot of things right now, painting broad brushes is generally not that constructive.
Alicia, I want to bring you into the conversation with this question. Future Fund probably deals with JP Morgan in one way, one form or another. I suspect everybody else on this panel deals with JP Morgan in one form or another. They are a huge force in global financial markets. Is a bigger, stronger JP Morgan with presumably even more pricing power than it had before a good thing or a bad thing?
I think a stable financial system is just really important to the operation of the economy. And so as we think about what's been happening in the market, The government have been stepping in to create stability in the market, and I think that's really important. And so I think overall, stability in the market
Trumps everything else?
Trumps everything else you're talking about there.
Much has clearly changed in the private equity industry over the past 18 months. You all know this, but I'm going to say it for the record. Interest rates are a lot higher, deal volumes are down, fundraising is much tougher. And of course, on the operating side, the economy is lurching to a standstill and possibly into a recession. And of course, we now have a state of high tension in geopolitics, as well as ongoing challenges or perhaps new norms in supply chains and logistics. Scott, I'd like you to give us, from your perspective, an overview of what I've just described. What's it like trying to buy businesses? What's it like trying to exit right now? What's it like trying to raise new money? Those things and anything else you feel like adding.
Sure. So at One Rock, we look for three things in a deal, and that has not changed since we started the company back in 2010. Number one, it has to be fundamentally a well-positioned asset. It's got to be a leader in either brand or market share or technology, something that makes it attractive so that when we go to sell the asset, that there are willing buyers on the other side of the trade. Number two is it has to be improvable under our ownership period. So we run a model where we have a dedicated group of operating partners that are really digging into the various aspects of the businesses to try to make them better during our ownership period. And number three is price. And we are value investors, so we have to require a really sharp price on the entry. And in an environment where people who are selling their companies tend to be anchored towards the peak of the market, it's really hard to narrow that bid-ask spread that exists in the marketplace today. Given the lack of availability of financing, you really need a motivated seller to find a valuation where there will be a willing buyer and a willing seller. For us, that means tending towards situations where you do have a very motivated seller. One area that we have specialized in over the last 13 years has been corporate carve-outs, because oftentimes a parent company makes a strategic decision that they want to exit a certain business. It's dilutive to their growth story, it's dilutive to their margin story. They've made the corporate directive that they want to get out of a business, and at that point, they become a motivated seller. And oftentimes, price is less important to them than what it has been for somebody who has owned a business in a private equity fund or a family looking to sell a business. And so we're really trying to pick our spots that way in a market that is otherwise very disrupted, and there would be lots of no deals.
David, Jacob, you want to share your experience? I think it would be instructive for people to hear what things look like from where you sit.
Well, I think now is a time where you have to really leverage your firm's capability to be creative. You have sellers and buyers with different opinions about value. Values change significantly in a short period of time. And you have to go back to some tools that really were put away for a while during a very high growth economy. Things like seller financing, things like seller rolling into transactions, things like that to get deals done. We recently did a $4.6 billion add-on to an existing portfolio, and we had the largest shareholder roll equity and provide seller financing to be able to get a transaction done today.
So we're a little bit different, I think, than Jacob and Scott in that we're not pure value buyers. We invest in only business services, 6 verticals that we're very focused on. But think of us, I'll use a public company context, we're GARP, we're growth at a reasonable price. There are a lot of similarities, though, in terms of the resiliency of the industry is a fundamental piece of analysis we do up front. Whether we're in a market like now, which is much choppier, or a more robust market, it's always important. Cash flow is always important. It's a lot more important now when the cost of your debt is doubled in the past year. We don't max leverage, for example, so we're trying to play offense and defense. We are getting things done. Similarly, lots of add-ons. a lot more creative with the structuring, a lot more sensitivities on what are you underwriting because there just is a lot more uncertainty. But we've also learned over many years, it's really hard to pick a vintage and say, I'm going to be all in, or I'm going to be all out. So we think about it over a long period of time. Can you consistently deploy and return and realize those asymmetric returns that we're all looking for?
I was going to get into this question a little bit later, but since the subject of vintage came up, I think, Wilson, you seem like the perfect person to ask a question about fund vintages. Maybe respond a little bit to what David said, and also add some color to the question of whether the crazy amount of money that was raised in 2021 and 22 in particular is going to be, or at least is going to give the industry, at the very least, heartburn, if not worse.
Sure. The analogy that I like to use in terms of where we've been and where we are now, in terms of the velocity in the private equity market, from a deal perspective, from a financing perspective, from a fundraising perspective, we had 10 or 12 years where all the lights were green, basically. Returns from private equity, if you were a mature investor in Europe or the United States, meaning you had a portfolio that was mostly about reinvestment and increasing your allocation. Not only did it out-return the public alternatives, but it provided plenty of liquidity to continue to grow. What's changed now is the lights have gone to yellow or red, in my analogy. Everything's harder. Financing's harder. There's a bid-ask spread on really good businesses. The IPO markets are not open. Corporate acquirers are not interested. They're distracted. So there's a lot of uncertainty, overlay geopolitical on top of all of that. From where I sit, the biggest issue in the industry that I see is the liquidity issue that I talked about. And because rates have changed and return expectations have changed across the allocation, there are opportunity costs that investors didn't have to think about for the last 12 years. I mean, fixed income, really interesting. Private credit, really interesting in this environment. So I think this is net good for everyone on this stage and private equity investors, because I think it certainly has slowed down activity levels, but prices have come down. Some of the excess will come out of the industry. The amounts of money that you referenced were committed but not invested. Some of it was invested, some of it's still on the sidelines and should benefit from these conditions once we get back to equilibrium. But what we're seeing right now on our co-investment side of our business are just the creativity that you would expect from private equity. Minority deals that keep a capital structure intact, really active acquisition pipelines to try and change the earnings power or leverage levels of a business to get through. And then finally, maybe the most interesting is the public to private opportunity, where the prices have come down in the public markets, and the private equity sponsors around the world are interested in buying back those businesses and taking them private again.
Alicia, if I understand correctly, Future Fund has been a steady allocator to private equity, but you didn't blow your brains out, when some of these mega funds were being raised, and maybe kept some cash in reserve. How do you feel about the vintages of private equity funds that you already own, and how aggressively are you allocating today, or are you perhaps waiting for an even better opportunity?
Yeah, it's a good question. I feel pretty good about the vintages we own, and I think part of that, we run a pretty concentrated portfolio to a selective group, and I think that over this next period, that selective group are going to get properly tested, but I actually feel pretty good about what they do. And so in this world where more active management of portfolio companies is likely to lead to going to be required to generate returns, I actually feel really good about the partners we have today. I also do feel pretty good about having capital to deploy. And in that capital to deploy version, though, right now, the reality would be, and I think Will just touched on it, debt for a private equity deal, I can earn 12.5% today. And so my ability to want to do equity, let's call it at 15 or 16 net, probably isn't there. And so that adjustment that everyone's talking about on pricing is real. And as a capital allocator, that is my alternative, right? I can just do the debt in the deals that aren't yet getting done. And so this adjustment has to take place to make capital want to be in the equity, assuming debt and debt rates stay as high as they are today.
I have a follow-on question, but before I get there, thank you, everybody. The questions are coming into the iPad. I'll go back to you, Scott, because I think you were the first person to raise the point about the gap between bids and offers. The question is this: are minority deals holding valuations at unrealistic prices?
Maybe. It remains to be seen. What'll be interesting to see when the gap gets narrowed is what kind of pressure will LPs put on the GPs to actually get realizations back and get the money back in the door? And is it the case that they're going to be able to raise that next fund and continue on their merry way of building larger and larger portfolios, or are LPs going to demand GPs to start selling assets? Or do they have some other solution, like in Will's practice, to be able to exit their LP stakes, bring the capital back in to redeploy in areas that they find interesting? I think it's a little early in the game to really determine what the catalyst is going to be, but that's when the rubber will hit the road, and I think we'll start to see valuations moderate at an accelerating pace when those kinds of pressures start to get applied.
Yeah, I would just add that I think there is going to be some carnage in 19 and 20 vintage funds in general in the asset class. I think the people you have up on stage here have strategies that will survive that well because value-oriented or just very, very careful investors. I think how people thought about how long this music would keep playing influenced how they invested, and some people did not do that well. And in a covenantless world, you don't really have a trigger event until you have a maturity. And maturities are going to start coming up in a year or two that are going to impact, I think, some firms pretty significantly. So we find that to be a pretty exciting world to invest in as a value investor. But just to your vintage point, I do think there's going to be some carnage.
Hey, Eric, one specific on the question about minority investment. I would just add that you really need to look and see if there's structure, because you will see, I think, and we've seen, I'm sure you guys have seen already, deal opportunities where somebody is looking for a certain value, but they'll give you preference. So all of a sudden we can say, well, we're buying the asset through 8 times. They want to market 12, so they're saying it's valued at 12, but we only paid 8 because we're in front of their capital. And I think that's not always the case. Sometimes you're coming in heads up, but structure is really important when you think about valuation.
And it's a possibility that that's part of the maturity solution as well.
Right.
So capital goes in, maybe at a preferred stock level. It gives the existing investors some money back, but also puts money on the balance sheet to help handle some of the maturities. Because once these maturities come up, you probably cannot refinance that debt at the same leverage level that you could in the past. And so you're going to have less leverage, probably at a higher interest rate. You may have the same, sort of debt service requirements, but those kinds of solutions could impact the ability to hold assets longer.
Alicia, there's another question from the audience here, and it's a strong, pointy question. So many funds look the same, as do the folks who work in them. This leads to a lack of industry creativity. Is this poised to change?
It's a really good question. I think that if one of the things when we are looking at funds that we think about is what does the partnership look like and who's around the table. And we are big believers in diverse groups make better decisions. And so I think that is a premise that we at the Future Fund have held, appears to be catching on amongst LPs more recently, which I don't think is such a bad thing. And so my expectation is and if I go back, sometimes maybe people go, it hasn't looked like it's changed much. Having been invested in this space for the last 20 years, I can tell you it absolutely has. Maybe not as fast as you'd like to see, but things have been changing and moving, and I think that is positive. I do think that if I come over to the VC side of the fence, it's the father of innovation, right? And everyone here on the panel is just talking about things like structures that are, thinking innovatively about ways to get through what is an interesting economic environment. And I actually do think that's part of the power of private equity, this ability to be in front of problems early, or what could potentially be problems, finding solutions so that companies make it through. And we saw this in that 2008 to 2010 period, and then still owning them to come out the other side. And so I actually feel I am hopeful for the industry that we're moving in the right direction.
There's another question along similar lines, different enough though that it's worth asking, and I'm going to put it to Wilson, because you too are an investor in private equity managers. You buy LP interests, you co-invest as well. The panelists reflect mostly old school, low growth / value thinking. It's a commodity class of capital targeting low to mid-teens IRRs for firms are, this is where it sounds similar, largely indistinguishable from one another. How are you adjusting your strategies to differentiate, and what do you look for in managers who can provide more alpha?
Well, I'm going to let these folks defend themselves. We're an investor with all of them, but we think of Lexington as we're investors in more than 2,500 private equity funds, so all the way from venture up to boring old buyout in manufacturing deals and everything in between. So look, what we're able to do is construct a portfolio that reflects really the past 5 to 7 vintage years. That's where the bulk of our unrealized value comes from in the portfolios that we acquire or the commitments that we make to managers. So we built very diversified portfolios over the years, approximately 65% buyout, 15% venture, 10% growth, the balance in things like infrastructure, energy, credit, that are parts of portfolios that we buy. So, what we're trying to do is deliver investors very consistent net returns that are attractive on a risk-adjusted basis. Now, the level of diversification that we provide to our investors, I hope, and delivers a very tight bandwidth of returns. So we're not a venture-type risk manager. But believe me, if you could pick and choose parts of our portfolio, there's plenty of that risk out there if you're interested in it.
There is healthy interest among members of the audience in the macro environment. Some questions here about interest rates and inflation. I'll put it to Jacob, and then I'm interested in input from others. How do you manage not just the macro environment that we're currently in, but the level of uncertainty that persists around the trajectory of interest rates and the economy as a whole?
Yeah, it's a great question. So first of all, as investors, we all have learned to underwrite and manage a certain level of uncertainty all the time. But we're in an amplified, uncertain environment. And I think in an environment like this, you have to be careful about trying to be a predictor. And instead, you have to be focusing on investments where you don't have to be good at prediction. So, for example, buying businesses today that can not only survive inflation, but can thrive in inflation, but at the same time are businesses that you can protect in a recession. And I also think from an interest rate point of view, you just have to be prepared for longer, higher for longer, and your investments have to work in that context.
Yeah, just said slightly differently, one of the things that when I sit in our investment committee meetings and we convene as a group globally, one of the things that we're always weighing is what can happen from a macro perspective and what is within our control once we own a business. And our strategy is one where we have operating partners that'll go in and fix supply chain and fix the lean manufacturing operation and reinvigorate sales and really try to improve the businesses. And so what we're trying to figure out is the value creation within our control? And if it is, and we can price that risk appropriately, then we will seriously consider that investment. But if the investment is predicated on some macro rebound or low interest rates or rising multiples, that's just not interesting. And I think most private equity firms that are focused on the value space would agree with that.
So you can, in your mind, continue, let me put it this way, do deals on a purely fundamental and traditional bottoms-up value analysis basis, even with so many variables in the overall equation?
Yeah, look, it's been really hard over the last, call it 12 years, going from 2010 up to, from the wake of the global financial crisis all the way up and through COVID. It's been a very benign environment. The lights were definitely all green, and now you really have to, that was an environment where value type of investments were very rare. And now we're starting to see an environment where we think that there's going to be more opportunities, and we've had to sort of open the aperture to look at many, many more deals in order to get the few deals that we get done per year. But yes, those are available. It just takes, very strong discipline and consistently applied discipline to find them.
Can I add, the only thing you know for sure the day you close the deal is your model's wrong, right? We all have 50-page elaborate models built up by facility, by product, by service, revenue, gross margin, et cetera. And of course, it's critically important to do that because you have to understand the levers of the business, but it's false precision. And we all know that. And so it really gets to what are the probabilities, what are the sensitivities, and where are you focused? And I think, again, we're a little bit different in our orientation, but there's a very strong focus on what industries are we investing in and why. And for us, they're industries that we think have good secular growth trends. People talk about thematic investing, technology, demographics, health and wellness, pick your areas. But combine that with industries and sectors that are more resilient in downturns. Doesn't mean they're immune, but they don't draw down 30, 40, 50% like a commodity business or other businesses. So it starts for us with the industry. And the other really key distinction in our mind versus a public market, we're underwriting for 5 years. So we certainly don't have a crystal ball for the next quarter or two any more than anybody else. But if we're underwriting for 5 years in an industry that we think is both resilient with upside and we can price that appropriately and structure it, that can be really attractive.
Here's a question that comes up I'm sorry, go ahead.
I was just going to add one thing to that. I think it's really important to remember some fundamental things about our industry. I mean, these companies are generally controlled by the sponsor, right? So, in an environment like this where rates have moved up, best companies aren't for sale. You hold them, you continue to grow cash flow, you pay down debt, you create value that way. We're not going to see significant M&A sponsor to sponsor, and that's where a lot of our industry's deal volume comes from, until we reach more of an equilibrium. There's too much uncertainty right now. So, things like minority deals, you had a question about that. I think they're back to the point on First Republic. You've got really smart, willing buyers and willing sellers who are doing deals in this environment. And some of them are unlevered. So they're showing you conviction that they're buying a terrific business and prepared to deal with goosing the return through leverage down the road. So I think it's just important to remember that control and the control premium that's part of private equity.
I was saying there's a question here that is often put to people who've had a lengthy career in liquid markets, more on the trading or shorter term investing side. But I think it's relevant to this audience, so we'll put it to to our panelists. What percentage of your investment staff started their careers post-2008? Meaning, of course, they have not lived through, at least for the most part as an adult, or managed through a downturn.
Well, I'll speak on behalf of Platinum. So we have an extremely long tenured team. At the partner level, I bring down the average, having been there for 21 years. And when you expand it to principals and managing directors, about 60 deep, we're getting close to 15 years. So a lot of people have been around a long time and have seen many cycles. But I think the point is a good point, which is there are a lot of private equity investors whose entire careers have been in an environment where interest rates have been decreasing and multiples have been expanding, and that's an easier environment to navigate. Let's put it that way.
We'll just go quickly down the line, Scott.
Yeah. So similar to Jacob, at the partner level, I believe all of our partners have been through multiple cycles, including the global financial crisis. But we do tend to have a younger team. Which is why it's incumbent upon our investment committee to do the underwriting that we do. And again, we're trying to weigh the macro things that can affect us and really measure what we can do idiosyncratically with the business. And that's what we focus on to drive our returns.
We're similar to Scott. All the senior partners were in the market in the financial crisis. They were not all senior people, though, for sure. So you got to have the mix, and all the junior folks, obviously.
And Alicia, within private equity at Future Fund?
So the team today is PE is 10 people. 5 of them would have 15 years plus.
Will?
Our investment committee, I think, averages 21 years, but we're a 160-person organization, so I'm trying to do the math. I mean, there's got to be at least 50, 60 people who are in the organization, but I would say 10 to 15 on the investment team. But, it's about culture and reiterating through your investment process what you learned and what you need to look for in your underwriting.
I want to go back to macro at the risk of seeming like I'm jumping around a little bit, but it's important. Alicia, I know, having spent a fair bit of time with your boss, Ralph Arndt, who's enjoying the proceedings from the front row here, that forecasting is a critical part of the Future Fund process. In fact, Future Fund has published, I'm aware of this because I've talked to Ralph about it and I've read it. There's some very interesting public documents that I encourage everybody to read about their thinking on this subject. So with that in mind, again, going back to macro, what kind of a macro environment do you anticipate these managers are going to be working through for the next 12, 24, 36 months?
Yeah, it's a good question. I think we run a scenarios-based model and we talk about some of this in some of our papers. But if I start with the fundamental premise of what markets are pricing today, they are pricing, I think, a pretty soft recession or a soft landing, and that the Fed will be able to reduce rates as you start to see signs of a recession. So we think in sort of 3-year, medium-term horizon, especially sitting in a private markets team, because like all these people have just said, we hold assets for long periods of time, but we do think it's important. And I think a couple of things, I think there is risk to that scenario that I just outlined that the market is pricing right now. And the risks are that inflation stay higher for longer. I know everyone celebrates when it goes from 7 to 6.6, but it's still well above the band of where anyone wants it to be. And I think, there are some things, and we talk about this in the paper that you just referenced, things like the energy transition is going to require a pretty big expenditure. That probably has the potential to continue to be inflationary. The current deglobalization and geopolitics, you would have to say, as people value resiliency over sort of efficiency in their supply chains and bring things back on shore. It's probably going to cost a little bit more, and as it costs a little bit more over the long term, over the next couple of years. And so if the base case is actually inflation's going to be under control so the Fed can cut, we think there is risk that actually inflation might be a little bit harder to get under control than the market's currently pricing. And we think that is something that you have to think about as an investor. You can buy the very best assets in the world, but over the next couple of years, if inflation stays high, you want protection for that in your portfolio.
Has some expertise, let's say, or know-how in macro become essential in your mind, no matter how narrow your focus or how small your business, in order to have a good enough handle on the changing circumstances in geopolitics or disrupt? I mean, here's where AI comes into the equation. The disruptive impact of technologies such as AI, being able to figure out who the winners and losers might be, placing your bets accordingly, and furthermore, deciding which risks to manage most aggressively.
Yeah, I think when you've seen periods of disruption, if you roll back, and I mean the private equity industry has seen it in the bricks and mortar retail sector, that ability to fight massive innovation and actually generate really strong returns when the market's going against you is very, very hard. And so if you do believe that there are significant forces out there that are going to impact industries, I think it would be remiss of anyone not to be looking at that. And I think one of the really privileged positions we get is we get to see across managers and across asset classes. And I think one of the reasons at the Future Fund we don't run an asset allocation, we run this total portfolio approach. And that is so that we can share all those insights of what you're seeing and what you're doing. And an example of that would be one of the things our team a number of years ago were doing on the infrastructure side when they started talking about data centres, and you sort of looked around and went, we've been doing data centres for the last 10 years in private equity, but you caught that trend that these were turning into infrastructure-like assets, which is where they are today, and that whole data transition. And so that ability to see those trends and make decisions about how to invest behind them, I think in the last 10 years have been ways to boost your returns, which has been great, but actually they might be needed as defensive mechanisms as we believe returns are going to be harder to generate over this next period.
David, I might ask you, and feel free anybody else to jump in on this question. If Alicia is right, and some element of expertise in seeing the world from 10,000 or 100,000 feet is critical, how do you develop that? InvestCorp is a pretty large firm, 50 billion in assets across private equity, credit, and real estate. Is this something that you're working on in-house, or is this something you outsource?
I think both is the short answer. And I think it's incumbent upon all of us to stay as current as we can, of course, but actually the data center example is a good one. It's applying the macro to the micro. And what's your sector? We have a couple of infrastructure services business, for example. Their demand drivers are going to be very different than a consumer business. And we spend a lot more time on that. And the other comment I would make is I think we've all seen all the studies predicting is just impossible. So it's really more, the way we think about it, it's more about the probabilities of what may happen and how might that impact the asset and what do we need to do to either grow it or protect it.
Mm-hmm. We would agree. For us, it's mostly an insourced model. So whereas, we don't have macroeconomists on staff, but we do have industry experts who are constantly looking at the various trends within an industry and trying to figure out, okay, the playbook is no longer buy a North American business, outsource the manufacturing to China in some way, shape, or form. That trend is over. What's the alternative? Is it to bring it back to the US? Is it to bring it to Mexico? What are the various solutions? We find that to be extremely important and help us avoid mistakes within our industries that we invest.
Yeah, I don't think you should ever be a blind investor. So thinking about macro matters. There is a plethora, though, of third-party information, whole research community focused on this, but adding industry expertise that you have to that and tending to be on the more conservative side. There's always a range of views out there, and just tending to be on the more conservative side is, I think, how you have to incorporate macro into your investment strategy.
I'd say as an allocator of capital to private equity managers, I would be very skeptical of macro expertise. and would suggest that the real secret sauce with many of our best managers is the information that comes from their portfolio companies that they've owned over many years, decades, and have stayed close to the management teams and sometimes used the management teams in additional acquisitions in similar industries. It's really from the industry competitive level that some of these issues are flushed out real time rather than around an investment committee table.
And maybe just to add one thing, what I've learned to be the most critical thing is the ability to react quickly. It's to understand that, oh my gosh, something isn't working anymore, or the margin's gone down, or we're at risk of losing a customer. What are we going to do? And being able to make those changes immediately, whether it's passing through raw material costs or reinvigorating sales for a new channel, if something else is at risk, making those decisions quickly is super, super important, which is why the control model, in our view, is one where it's absolutely essential to at least the playbook that we have.
We've been talking a lot about the financial side of the private equity equation. Of course, operations, as you just touched on, Scott, are a critical part of adding value and creating alpha in private equity. There's some questions from the audience here that touch on operating risks and maybe some other things that straddle financing and operations. And they want to know about the impact of supply chain strains. And I would add that it seems like things have really changed from where we were in the earlier, not the early days of private equity, but maybe pre-crisis-ish area, or the early teens, where a lot of the optimization on the operating side was about reducing cost and moving things overseas. Feels like a different era. And also about managing interest rate risk, specifically around interest expense and near-term maturities. Who wants to take a stab at that? They're two different, obviously two very different things, but.
Yeah, on supply chain, I think everybody in one fashion or other got caught by surprise at impact on supply chain in one or more companies. It was a whack-a-mole in many ways, lots of unexpected effects and interlinked, but I think there is a new premium on resilience versus just-in-time and lowest cost. And Alicia, you were talking about that a little bit earlier. So I think resilience is now weighted a little bit more heavily on making sure your supply chain multi-sourced, multi-jurisdictional. This concept of nearshoring in some contexts more important as well. All inflationary things, by the way, but important.
Scott or David, anything you want to add?
Yeah, I would totally agree. And one of the interesting angles that we've started to see across our portfolio is the more nearshore you are, the better off our companies are able to articulate to our company's customers that it's a good ESG solution as well. And so
From a carbon footprint
standpoint. If you're not bringing goods halfway around the world, think of the carbon emissions that are being eliminated by sourcing from the local supplier if you're producing in region for region. And so that's been an additional angle that we've used in certain cases in our portfolio to articulate to our companies that they need to be articulating this to their customers, because oftentimes it does result in the ability to win the sale or maybe charge a premium in certain cases by being a good ESG solution for those customers as well.
There is a very relevant question on that note from the audience. How does the mandate from LPs, I'm not sure if it's a mandate necessarily from you, Alicia, or from you, Wilson, but how does the mandate from LPs to invest in decarbonization or to decarbonize your business, does it conflict with pursuing, this really is a chicken and egg question, of course, but does it conflict with pursuing the highest returns in the absence of that requirement?
Yeah, we don't think it does over the long term. I think that if you think about where we are today and the targets that are being set by countries, the work that is being done, and where the world is going, we think there is alignment between over the long term around generating returns and actually meeting some of those ESG obligations. And so, we just touched on perhaps, but I think interestingly in the example just given, I think in the last 12 or 18 months, that ability to pass through those cost increases as you've been building them into the end customer has existed because the economy has been so strong. I guess the big question everyone has, if these costs keep going up as you want to be doing things slightly differently, how long can you pass that through? Because when you can no longer pass that through, it gets to be a much more complicated decision for you about what you do, right? And so I think that, but I do think, coming back to that question, that this alignment between long-term, between what LPs are asking for from an ESG side and actually what will lead to great industries and real value are completely aligned.
I agree.
I guess one question for the managers is, to what degree do you feel pressure to make your business, broadly speaking, the manner in which you run your companies, for the most part, more sustainable? And we could define sustainability in many ways, but let's just use it as a general term. And would you run it the same way in the absence of those demands?
I'll start. Again, we only invest in business services, so in that sense, it's maybe a little easier because we don't have heavy manufacturing, et cetera. But I agree with what Alicia said. I think it's becoming a virtuous circle as opposed to a vicious circle. The LPs demand it. Customers of our portfolio companies increasingly demand it. Employees demand it. So not only is it the right thing to do, quote unquote, I think it is going to ultimately be a virtuous cycle. And it is requiring a lot more time, attention, and effort for sure.
Scott?
I would agree with that. I think there is a premium placed on businesses that are showing a decarbonization trend. And especially for those of us who are investing in the industrial sectors of the economy, we recognize we have to be part of the solution as it relates to ESG. And so one of the things that we do is try to, again, we're articulating to our portfolio companies' customers that we're buying more sustainable power or sourcing goods more sustainably, or to the extent that it's a consumer-facing business, we're using more sustainable packaging or raw materials. Those are things that get a premium in the market, and it gets a premium when we go to sell the businesses as well. And so I don't believe we've seen any marketing materials for offering memorandums for potential deals recently that didn't have at least some discussion of ESG trends.
Jacob?
Yeah, I would just add that as long as the ecosystem in the investment community are all holding hands on it, it's going to continue and it's going to be a net positive. If it gets decoupled or politicized, there's a risk that you could actually be disadvantaged by pushing ESG. But I think it's a good thing for the world. I think that, to Scott's point, if you're getting a premium in supplying a product that you can articulate is producing less carbon from your customer, and your customer has pressure from their customers, et cetera, as long as that ecosystem is all working, then I think it's a good place to be and a good place to invest.
I don't think I'm going out on a limb here by pointing out that in a not small number of cases it is getting politicized. So if that's happening, you're nodding your head, so I think maybe you agree. Do you change the way that you communicate this to people? Do you say to yourself, if I talk up the carbon efficiency of my companies, or the degree to which they are or are not sustainable, am I putting at risk the potential of getting an investment mandate from a certain state treasurer?
Yeah, so I think it's probably different in the public markets than it is in the private markets. So in the private markets, again, we're in control of these businesses to the extent that we're making them better and more valuable. Then it's a win-win, right? If we're making a business more ESG friendly and that gets us a higher sale price at the end of the ownership period, then it's a win-win-win. Everybody wins. In the public markets, I think it's maybe a little bit differently. I haven't totally thought this through, but I think part of the rationale of divesting from certain industries that are perceived to be less ESG friendly is to drive down the price. It's to, maybe limit the availability of capital. And that, because you're not in control, you're not actually fixing the problem. You're just hoping to create a market mechanism by which you force management to fix the problem. So, I think in our world, those of us in the private world, it's just a much more direct way that we have an additional avenue to create value.
Well, I saw you nodding your head here.
Well, I was just saying, thinking to myself, a growing, highly profitable business that is a good citizen, if that commands a premium, that is the bridge between the political divide that you're describing, and I think our industry is aiming to demonstrate that.
While we still have some time left, I want to return to the fundamental theme, deal or no deal, which does come down to deploying capital or not deploying capital. I'll come back to you now, Will. Do you want your managers to be deploying some of this committed capital, even if it means accepting the prospect or likelihood of lower returns?
No, but I'm not sure I agree with the premise. I mean, you
okay.
Can I disagree with the fundamental question? I think we can't call vintage years. Nobody has a crystal ball. I told you what my value of macro was. I think what our LPs demand of us and we demand of our managers is to manage risk as best they can, deploy across the cycle in a disciplined and thoughtful way in areas where they have competitive advantage. And, most investors, I think, are prepared to let the chips fall where they may and control their deployment into this asset class in a very consistent manner. Nobody's trying to shoot the moon here. We're trying to deliver attractive returns from within the private equity allocation for retirees over generations. So I think it's about, sort of hitting the pitch in front of you. Football analogy, 3 yards in a cloud of dust. Now's not the time for home runs. It's, good solid deals and demonstrating that you can find them, finance them, and operate them from the point at which you close them where your model's wrong.
Alicia, what do you want your managers to be doing?
Definitely don't want them to be going for lower returns. I think that, but I don't think anyone is thinking like that in this environment, right? I think that thinking more innovatively, finding interesting, I actually think it's a really interesting time when capital is more scarce, perhaps, than it has been, driven by the debt markets and potential, for the debt markets to get even tighter. I think we were hearing today on some of the banking panels that, the credit might get tighter over the next period. That's a great opportunity for anyone with capital to be able to look for opportunities and find great businesses that you can, great businesses at a fair price. They don't have to be cheap, but buying businesses you want to own for the next 5 to 10 years that perhaps you haven't even been able to get access to because they've had an abundance of capital, and be patient and buy those great businesses at a fair price. That's a great trade.
I don't know to what degree any of the managers here is out actively in the market seeking new capital, and if you are, I suspect there's some constraints that you might be operating under. But to what degree can you share with us, because there's no deals, of course, if there's no capital, what's it like trying to raise money right now in this environment?
Hard. Really hard.
As hard as it's ever been?
These guys probably raise more funds than I have, but I certainly in a long time, and there was a stat I just read this morning, I think the capital raised this quarter was comparable to last year, but the number of managers was cut in half. So LPs are narrowing their focus.
I think there is a lot of scrutiny being put on each manager. I think that's always the case, but certainly in an environment where there's less velocity of capital going into deals and coming back, I think there's a lot of, let's take a step back and look and see who the really good performing managers are, who's generating alpha versus levered beta, and it is making for certainly an elongated process.
And I would just say there is objectively less capital available for the industry, period. And so, but there's always capital available for people who can articulate why their strategy meets the moment. And for Platinum, value orientation, operational intensive, it resonates in the market, and you're going to be able to attract capital when you have a strategy that meets the moment.
Wilson?
It takes.
Go ahead, Alicia.
I was just going to say it takes longer, and you get to spend more time with your LPs. But there's still a lot of capital out there.
I was going to say there's still a lot of capital in dry powder, right? So there's a lot of capital still out there, and to be deployed would be my first one. And my second one is, I don't think I've ever seen it easier to fundraise than perhaps it was in 2021. If one more person came to me and said, I'll get it done in 6 weeks, what do you want to do? That was higher than I've ever seen it in 20 years. And so whilst it's absolutely harder than 2021, I think there is still capital out there. And I think it's more than just about, returns and strategy and all of that's important. But LPs remember, when it was really, really easy to fundraise, how GPs treated the LPs. LPs remember that now, and you've seen that happen. So the best thing I can say is, when the pendulum's maybe swinging the GP way, you should treat your LPs pretty fairly, and I think you'll find them give that back to you in an environment where it gets a bit tighter.
And that, ladies and gentlemen, is the last word on Deal or No Deal in private equity. Please join me in thanking our panelists.